Okay, welcome back to part 2 of our Module 1 video covering the Intro to Accounting Concepts and Principles. So in part 1 of this module, we ended up with the topic, a discussion of the various concepts, principles, assumptions that apply in accounting information. Now we're going to move on and we're going to talk about the qualitative characteristics of accounting information first of all. Now this is something that it's nice to know up front. It's not necessarily something you'll have to regurgitate later on as you're going through, but it's good to set the stage. So the overarching principle of accounting information is that we want it to be useful in making decisions. It has to have decision usefulness. And over the years, the thought is that this information, to be useful in making decisions, needs to be both relevant and reliable, which is also known as, it has to have representational faithfulness, but that's just another way of saying reliable. So to be relevant, the information has to have either predictive value, help us to predict a future outcome, and or feedback value, help us to determine whether a previous prediction was correct or not. Now, of course, to be relevant, it has to be timely. It doesn't do us any good if we don't get this information until after, a year or so later. That's too late to make a decision. To be reliable, the information has to be verifiable. In other words, an auditor or somebody else can recreate these financial statements by looking at the transactions and they would agree with them. It also has to be neutral, which basically means that we don't want somebody spinning this information. We want it to be fair, honest information, neutral, no conflict of interest. Some other elements that come into play with the qualitative characteristics would be comparability and consistency. They go hand in hand. We talked about this in part 1. We basically said that they need to use the same standards from period to period. And then we also said that there are some exceptions to it, but even when they have those exceptions, they still have to ensure that this information is comparable by going back and restating the earlier years. It certainly has to be understandable to a person with a reasonable expectation of understandability. In other words, not somebody off the street that doesn't know anything about accounting. Somebody with a reasonable background in accounting and business should be able to read these financial statements and understand them, understand the status of the company. And we also talked about, these are some constraints. The cost-benefit constraint. You don't want to spend a lot of extra money getting better information if that extra information is not going to really benefit the users. It's not worth spending the additional cost in that case. And this really leads into materiality. This is why we have materiality. When we're auditing, we only look for material errors. We don't look for every possible penny or even dollar that could exist. We look for material errors that matter to people's decision making. So now we are going to spend time introducing the 4 core financial statements. We dig into these statements in a lot more detail in later modules, but we're going to introduce them now because it's helpful to understand them as we go through the other modules. And these are in the order that they would be created and presented. You start with the income statement, which we'll see later on shows essentially the profit or loss of the company. It shows revenues minus expenses. That actually feeds in to the statement of changes in owner's equity. As we'll see shortly, the income becomes part of owner's equity through retained earnings. Now I know we're not spending too much time on that now, that you probably won't recall it from this first discussion. We definitely will dig into that later on. In fact, in just a few slides, we'll see this retained earnings statement. The point is, the more income you have, the more equity the owners have in the company. That's how their equity grows. Now, owner's equity is one of the components of the balance sheet. We'll basically list out assets, liabilities, and owner's equity. So the balance sheet just shows the balance of all of those at a point in time. And then finally, we have the statement of cash flows, which shows where the cash has come in from, where the cash went to, in more specific detail. So we'll see the income statement here first. And again, we're going to list out the revenues, all the revenues that have been earned this year or this period, all of the expenses that have been incurred to help us generate revenues. Net income is basically revenues minus expenses, and that amount gets carried forward to the retained earnings statement. By the way, this is a period of time statement. It's either a month, a quarter, or a year, depending on what period they want to record. And here's an example of a very basic income statement. Here's for the year. We have these two types of revenues this company has. So they have a total revenue subtotal. Here are all the expenses this company has. Cost of goods sold is basically the expense of selling inventory. They have a total of expense of $100,750. So the difference is $74,250 for net income. This net income carries forward to the retained earnings statement. Now, the retained earnings statement is a portion of the statement of owner's equity, also known as the statement of changes in owner's equity. It shows two basic things. The paid-in capital, also known as contributed capital, this is basically all the stock the company has issued, and it's investors that have paid money into this company to help it grow. So that's paid-in capital. And we have retained earnings, also known as earned capital. It's basically what the company did with that money. They help to generate income, which grows the company over time. Now, to get the ending balance of retained earnings, you would take your beginning retained earnings from last year, essentially, plus the net income, which is revenues minus expenses. Remember, that flowed from the last statement. And you'd subtract out any dividends that you paid, because if you paid or distributed dividends, those are no longer retained earnings. Retained earnings are the amounts that are kept within the company, reinvested in the company. Then you have a period of time. This is a month, quarter, year, whatever we're talking about. Here's a brief example of how this looks. We have common stock. We'll get into additional paid-in capital in excess of par, what that really means later on in a later video. Retained earnings, and same with treasury stock. We'll talk more about that later on. But these are all pieces of equity, and it shows how things have changed. We talked about how retained earnings change. Common stock, you either issue more stock or you buy stock back. By the way, just to give you a heads up, treasury stock is them buying back stock. Additional paid-in capital is it's tied to the stock issuance. It's part of the issue price. I'll leave it at that for now until we get into a later module. So the next statement we're talking about is the balance sheet. And there's an equation that we're going to spend the last part of this module on called the accounting equation or the balance sheet equation. And this is one that absolutely has no exception. This must remain in balance. Assets, the total of all of our assets, must equal our liabilities plus equity. This is fundamental to double entry accounting. So this is an absolute requirement. Here you'll see, oh, by the way, this is a point in time statement. As of this date, this is what our balances look like, as opposed to a period of time like the other statements. So here are all the balances of all of our assets, and we have a total of 1.1 million, 1,174,000. Then we list out all of our liabilities and our common stock, our equity. And here we have a total of 1,174,000 as well. So again, we're in balance. We're good to go. It gives investors a running total of the various accounts. The statement of cash flows, we're back to a period of time, and in this case, a year. Now notice this is important because they tell us the three business activity types that a company has that everything can be grouped into. And these are also the three activity types that are found in the statement of cash flows. So we have operating activities, which is basically our core operations. This is the majority of the activities we have. Selling products, selling service. And again, we're talking cash, so we're talking the cash related to them. But then we also have all the cash paid for expenses in our normal business. So we have the operating activities, the investing activities, which is basically the buying and selling of long-term assets, cash coming in, cash going out. We have financing activities, which is basically borrowing money or issuing stock and then maybe paying those things back. We'll definitely dig into this in much more detail later. This is just an introduction, but it's all about cash now. It's not about when did we earn something or when did we incur something. So the cash flow statement and the income statement, they're under different bases of accounting, but they're both very useful to investors and creditors. So we take that total change in cash, we add it to the beginning balance of cash to identify what the ending balance of cash must be. Now we're going to dig into some terms we've already seen, but these are the different account classifications, which is going to set the stage for our accounting equation discussion, as well as next module's normal balance discussion. So here we're going to say 6 core classifications. We have assets, liabilities, paid in capital. Now again, I'll define assets here in just a bit. We'll define all of these in just a bit. But we have these 3. We have revenues, expenses, and dividends. So retained earnings, we talked about that account. We talked about that term a few slides ago, a few times actually. And the reason we're not listing that as a core classification is that it's actually a combination of other accounts. Remember, we said retained earnings is calculated by adding revenues, subtracting expenses, subtracting dividends to get your ending balance of retained earnings. Notice, though, that retained earnings is another type of equity along with paid in or contributed capital. This particular one is often referred to as earned capital. So we're going to keep that separate from our core account classifications. Now we have assets. These are the items that are resources that are owned by the company. So what do they have that they own, they can use? We have cash, very important one. We have accounts receivables, which these are basically amounts that are owed to this company. We are going to receive them from customers generally in the near future. We have supplies that we're going to be using in our operations. It's an asset. We have inventory, which it's going to be used when we sell it. Now notice there's a slight difference between supplies and inventory. Supplies aren't sold, they're used up. Inventory is sold. It's what we're in the business of selling. The other thing I want to point out here, supplies is an asset, but we have a very closely related expense called supplies expense, which is the usage of this asset. Just like cost of goods sold is the use of this inventory. They work hand in hand. One goes down while the other goes up. We have office equipment and a variety of other equipment, which is a longer-term asset used by the company to operate its. We have liabilities, which a simple way of defining this is simply amounts owed by the company. We have accounts payable, notes payable, salaries payable. A lot of times they'll have payable after it because we have to pay it out to somebody. But there is one important one called unearned revenue, which we'll see in a later chapter. And this is basically an amount that we owe back to the customer, either by providing service or by paying them cash back. So liabilities, we have all the different revenues, which that depends on what that company wants to call them. They might have a sales number if they sell a product. It might be a service type revenue. They may call it fees earned. But again, these are core operations. The normal business operations, we're earning these revenues. That's different than a gain. Even though a gain is a good thing, it impacts net income. It's a positive amount. But revenues are core operations. Gains are peripheral type transactions. It's not your normal business, but occasionally it happens. Generally, this is something like you've sold a piece of equipment that you've been using for years, and you sold it for more than what it was worth on your books. So you have a gain. Expenses, as we described before, are amounts incurred by the company in order to generate revenue through their normal business operations. So in other words, to generate revenue, you're going to have certain costs you have to incur. Salaries expense for your employees. Utilities expense for obviously using the utilities. Cost of goods sold, that's the amount of inventory you've used up by selling it. And supplies expense, you've used up those supplies to run the company. Now, just as before, these are different than losses. Expenses are normal business operations. Losses are peripheral transactions. Take the example I mentioned earlier where we sold an asset that we've been using for years, and this time we sold it for less than what it appears to be worth on our books. That's all we could get out of it. Here we have paid-in capital or contributed capital. Now, these are the amounts that the investors or owners have paid into the company to help grow, and they expect a return on that investment. The thing is, this is not debt. This is not like the company owes that amount back at a certain point. Those owners are sharing in the risks and losses, the risks and rewards of that company. So they definitely expect an eventual return on that investment. Whether they get it or not depends on the success of the company. Now, dividends, this is one way to get a return on your investment. This is when the company decides to pay an amount back to investors out of their earnings. It's a return on their investment, but this is not considered an expense. It's called distributed earnings, or as opposed to retained earnings. So the company has a choice. Do they want to keep those earnings in the company to help it grow more, or do they feel it's best to pay the earnings back to the owners, who ultimately are entitled to it, depending, it's just a question of whether they get it now or whether they get it when the company liquidates years and years later or when the investor decides to sell the stock. We talked about retained earnings again, earned capital. This is the amount of income that has been retained by the company for future growth or investment. It has not yet been paid back to investors as a dividend, and it's, again, distributed earnings instead of dividends are distributed earnings instead of retained earnings. By the way, I do want to mention one thing. Retained earnings does not necessarily tie to a certain amount of cash on hand. If you have $100,000 of retained earnings, that does not necessarily mean you have to have $100,000 of cash. Maybe the company has used that to buy more equipment, to expand, or maybe they have more than that amount of cash from other reasons. They borrowed a lot of money or whatever. It does not have to tie. For the last section here, we're getting into our accounting equation, which is a very, very, very important piece of this module. It sets the stage for Module 2 and really everything after it. As we said when we looked at the balance sheet, this accounting equation must always remain in balance. So to define this, we're basically saying we have the assets must equal the liabilities plus equity. Assets are basically resources the company has. And you can think of liabilities and equity as either the claims to those resources. In other words, somebody has a claim against those. The first claim comes from the creditors, but the second claim comes from the owners. Whatever's left is theirs if the company liquidates. The other way to look at it is, okay, we have all these assets. How did we finance the purchase of those assets? We either borrowed money or investors invested money. Now, we could take a look at that simple equation and we restate that multiple ways depending on what we're looking for. Certain problems, we're given two numbers. We need to find the third. So if we just manipulate that a bit, for example, let's say we subtract liabilities from both sides of this equation, we end up with assets minus liabilities equals equity, or equity equals assets minus liabilities. Same thing there. If we instead subtracted liabilities from both sides of the equation, we get assets minus equity equals liabilities, or flip it around to say this: liabilities equals assets minus equity. The thing is, you must always know two of those items to determine the third. Now, what we're going to do for the last few slides is expand on that topic to show you some things you'll see with various exercises and assignments related to this. That equation also works on changes. So if the assets increased by $1,000, then we know that either liabilities or equity or a combination of both of those two must also increase by a net $1,000. Now here's an interesting one. What if the liabilities increased by $3,000? We know that since we have a $1,000 increase on the asset side, we need to get to a net $1,000 increase on the liabilities and equity side. So if we're already at 3,000 on liabilities, equity has to drop to pull that back down. It has to decrease by 2,000, and we have a net $1,000 increase. So here we are now expanding this accounting equation out a bit. Yes, we have multiple assets. We have multiple types of liabilities. But with equity, it's a little bit different. Instead of just calling these types, we're more calling them classifications or groupings, if you will. So owner's equity is grouped into, or it has two different categories, if you will. All the types of contributed capital or paid-in capital. These are the different stock items we'll talk about in later chapters. And then we have retained earnings. Now here we're talking the ending balance, which we already said to calculate that we take beginning retained earnings plus our net income, which is revenues minus expenses, minus our dividends. Now these red bold items I listed out go back to our standard classifications of accounts, our 6 classifications. So here we have another reminder that the accounting equation must always remain in balance. As we get into this next module, we're going to start talking about transactions and things like that. And the double entry accounting model that we use, that's been in use since 1494, requires that at least 2 accounts be impacted. Now you might have more than 2 accounts impacted as long as the net impact is the same on both sides of the equation. That's the example we said earlier. Maybe your assets increased by 1,000, but maybe you have a liability that decreases, or a liability that increases by quite a bit, and an equity that decreases. As long as they net out to the same dollar amount on both sides, we're fine. Now, another thing that could happen is both accounts might be on the same side of the equation. You might have one asset that increases by 1,000, another asset that decreases by 1,000. That's a 0 net impact, so you don't need to have anything on the liabilities and equity side. You might have things that are on the separate sides of the accounting equation, maybe an asset and then a liability both increase by 1,000, or maybe an asset and a liability both decrease by 1,000. That could certainly happen. And as we said, you can have more than 2 accounts impacted as long as the dollar amount balances out. So now we have a few examples we'll go through. Here, one example, we increased an asset, or one asset by $500, the other asset decreased by $500. There's a net 0 effect to assets. Maybe we increased the asset by $750, increased the liability by $750. We're good to go there as well. Maybe we increased revenue on the right side of the equation by 1,000, and we decreased liability by 1,000. That's also on the right-hand side. That nets out to 0. Maybe we increased an asset by 5,000 on the left side, increased a liability by 25,000 or 2,500 on the right side, and also increased equity by 2,500. That nets out to 5,000 on the right side. We're balanced out with the left side. The part where it gets tricky is when we start talking about expenses and dividends. So let's go back a few slides here and notice that there are negative signs, or we're subtracting dividends and expenses out. What happens here is when we increase an expense, it actually decreases net income, which decreases retained earnings, which decreases equity. A dividend does not impact net income itself, but when we increase the dividend, we're decreasing retained earnings, which decreases equity. So what we're saying here is on the left-hand side, let's say we decrease the asset by 800, and we increase an expense by 800. That's on the right-hand side. At first glance, it seems like we're out of balance. We're decreasing the left side, and it appears that we're increasing the right side, which we can't do. But in reality, yes, we can, because this increase to expense decreases equity, which is our main concern. So we have a decrease to an asset and an expense that leads to a decrease in equity. We're balanced out. The same thing holds true with a dividend. We decrease the asset by $450, We increase the dividend by $450, but that decreases equity. So we're still in balance here. Now that takes us to the end of our Module 1 for this course, both parts. Now the next module that we'll talk about is extremely important as well, and it really relates to a lot of this ending information. We now start talking about the true bookkeeping aspect of accounting. We talk about example transactions, how to enter journal entries. We talk about the importance of debits and credits and what those even mean. And we talk about the normal balances of accounts. So definitely take Module 1 first, and then we're moving into Module 2, and that'll really set the stage for the remainder of the course. So thanks for your time, and I will talk to you in our next section. Have a good one.